Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for July 30th, 2023. Wow, what a busy week and a very volatile week that we had last week. And we're going to talk all about the FOMC, the ECB and the BOJ here in just a few minutes. But I just wanted to say that, we were expecting a pretty volatile week. We got it. And I think the dollar is trying to really show us its true colors. Now, I'm going to get into that in just a moment, but I need to say this. If you like these videos, make sure you subscribe to the channel. Give our team a thumbs up as we put these videos together for you each and every week. I think we're going on about year 7 or 8 now. So if you like what you see here, please give us a thumbs up. Our whole team really appreciates that. And comment down below. If I missed something or if there's something that I said that doesn't quite make sense, jump in the comments below and let me know. All right, let's get into it and let's talk a little bit about the FOMC, the ECB, and also the BOJ. So let's go over to let me take you over to the dashboard of Forex Analytics and take you over to the calendar here. And if you recall, on Wednesday, Wednesday we had the Fed, right? The Fed raised rates as expected, and there's really one big takeaway that I had, and I'm gonna actually take us over to the dollar while I'm speaking about this right now, and then we're gonna go back to the calendar. One of the things that I wanted to mention about the dollar, and we were talking last week, this false breakdown and the pivotal area around the 100.80. Now we've got a false breakdown set in stone now on the weekly charts, on the daily charts. You can see this bull flag pattern as we approach really near-term resistance at 102. But the takeaway that I had was the Fed. Fed Chairman Powell, he was asked about a recession. He goes, even our internal economists aren't pricing in a recession. Now, the reason why this is important is because the market had been pricing, and still is, rate cuts for 2024. And he's like, we don't even see them in our projections in 2024 for a recession. Well, I think that's important. The market kind of, is obviously it's going to hear what it wants to hear. And I was talking to Jim Welsh about this on Friday. But I will say that when he said that, I'm surprised the dollar didn't have a better response, because the market is indeed pricing in a recession, but or pricing in rate cuts. But the reason why you get rate cuts is because you do get a recession. And if they're not seeing a recession in the future, that means that the market might be mispricing rate cuts into 2024. Now, I asked Jim why there wasn't a more positive response, and and Jim Welsh is from Macro Tides, by the way. His response was, well, the lack of recession really outweighs, market pricing in the future. So I guess I could agree with that for now, but I don't think the market should be ignoring that. I think the market should be paying attention to what the Fed chairman is saying. Rates are going to stay higher for longer, and don't expect rate cuts. Now, obviously that's translated into another new high in equities. You can see the S&P is not too much higher than where it was at the end of last week, but we're still skating across that ascending channel. We'll get more into those charts here in a minute, especially regarding equities. But now let's go over to the dollar. Well, we talked about the dollar just a moment ago, and I'll just say it again. Dollar is really pushing up against a 618 retracement, really critical here at the 102 level. That's going to be previous support, current resistance. You can see that resistance zone. I think we talked about it last week, how important this was if we closed above 1.01. Anyway, you can see the dollar's pushed right up against its 618 retracement. You see the 618 right here. High to low, 618, we're there, right? And we're stalling there. Also previous support. Now, the next component of the dollar index is going to be the ECB. And I have to say, Christine Lagarde's press conference, she was pretty dovish. I think she was pretty downbeat on the European economy. Rightfully so, because you've seen the economic data out of not only the Eurozone, but also out of Germany. Really turned lower as of late. And so the euro, notice where we went, all right? We dropped then you can, let me get rid of this here real fast on the euro. After completing that, AB equals CD, multiple levels there, you can see how we pivoted off of this broken trend line. That's the previous triangle. Do you see that? Do you see how well it did too? I mean, I know I'm being Mr. Obvious here now, but do you see that high, that pivot, that level? You guys all see that? All right, so now that shows you how important that support is moving forward for the euro. But it also, let me get rid of that really quick. Let's move this fib level over here. It's also the 50% retracement this whole last leg, right? So that to me tells us this, 109.50 or whatever the lows here are in the euro are going to be really important moving forward. And, one of the things that we should be paying attention to, and I'll talk a little bit about this, obviously what's happening throughout the course of the week, but on Monday we have the Eurozone CPI data coming out, so inflation data. And if that proves to be weaker and we continue to see these disinflationary pressures in the Eurozone, guess what? We would have a euro that might actually break the 50 DMA early next week. So just keep that in mind. All right, now let's talk a little bit about the BOJ. The BOJ, this was the big mover of the week. From a volatility standpoint, you can see this is the intraday volatility following the Bank of Japan. It's interesting. There was, a news article that came out of the Nikkei, earlier in the day, and it was really 2 o'clock in the morning, I guess, in Japan, local time, which the BOJ meeting was happening 10, 11 hours later, or their announcement was going to happen. Anyway, it alluded to the fact that the BOJ was going to tinker and tweak YCC, which in essence they ended up doing it. Now, it seems like there's a lot of confusion. Obviously, you can tell with the price action in the dollar yen following the BOJ. Let's acknowledge the fact that they are taking one step forward into normalizing rates, right? First, you start tweaking with yield curve control, which allows them the flexibility to have a band that they can move, because they can now control yields. If they have higher inflation, they can adjust yields appropriately to compensate for higher inflation and then lower it back again. Now, obviously, after that, you go into just getting rid of YCC and then going into rate hikes, straight up rate hikes after that. So there's obviously a process that the market's following. The reason why I think that you've seen the yen continue to weaken following the BOJ, so this is that intraday price action, but the reason why you continue to see it weaken intraday and towards the end of the day is stocks are still stronger. Ultimately, the market's still looking for carry interest. And, for all intents and purposes, risk is still quote unquote on. So you're seeing that happen. And I think that now that puts the US dollar, Japanese yen in more of a range type of environment where we could trade back up to 142 and then, support being maybe 138. We got a 400 pip trading range, really, I think, with the US dollar, Japanese yen to contend with near term. Obviously, one of the big things that the market's thinking about right now, and there was a lot of talk about this, is talk about how it will affect this move in yield curve control will affect bond yields and bonds and treasuries in general. Whether you're talking about notes or treasuries, and you can see here's the 10-year, but we can go to yields. A lot of people believe that if this happens and you see an adjustment with YCC, since Japanese investors, they are like literally some of the largest bond holders globally, and they make up about, the last statistic that I saw, they make up about 15% of U.S. Treasury foreign holdings. I mean, that's not a small amount. That's a pretty big amount. And what the thinking is here is if these Japanese investors start selling U.S. Treasuries and start buying up, local debt, yields, or bonds will come down and yields will go higher. And that's why we saw that initial spike higher. You can see it right here. This is a 1-hour chart, or actually, let me go to a 4-hour chart. It's going to be a little bit better. Okay, when we saw that initial spike in yields over here, that was one of the reasons that everybody was attributing to, what's happening in Japan. So will U.S. Treasuries really come under pressure when Japan normalizes rates? To an extent, I would think so. I think that helps yields go higher. And yes, there's going to be some natural selling pressure in the bond market. But don't forget, especially for those of you that are newer in the markets and maybe you've only seen so much, your experience is kind of limited in the market, which is fine. Everybody starts sometime. I remember when I was green in the markets in the 90s. I didn't understand a lot of things. Well, in this case, I want you to also keep in mind that there are periods where you see bonds go higher, dollar go higher, and yields actually go lower. A lot of people are, think that, yields are going to go down, the dollar is going to go down. So that's just how things work. That's not always the case. And you also realize just, over the last, year and actually several years, we've seen, bonds, bond or yields go higher, dollar goes higher and vice versa. But that could change, especially if you have a situation where stocks, start seeing some two-way price action, which could very easily be the case moving forward. So anyway, what the BOJ did this week was significant. I think it was a baby step. But keep in mind that I think the dollar yen is going to be more range bound than anything moving forward. And there are going to be other things that end up moving the market, the dollar yen or the yen in general, and that'll probably have more to do with what's happening in the bond markets and what's happening with risk appetite, meaning if stocks are going up or down, that's going to have a greater influence on the yen. But everything this week tells us that because of what we heard from the FOMC and the ECB and the BOJ, data matters more now than ever. So that means that you have to be aware of what's happening throughout the course of the week and be cognizant of the news that's coming out and how it can affect A, the economy, but B, interest rates from major central banks moving forward. But hey, that's what we do here on the Face Show and the, let me just take you right over here. If you guys don't go where we do our free shows every day, if you don't go to the Flow Show every day to get, if you're in European hours and listen to our European, Ryan Littlestone and Stelios and K-Man, and if you're not listening to that show every morning, it's free. Make sure you are, and the Face Show, where you're going to catch myself and the rest of the team there, getting you ready for the North American session. We do it every single day during the week, so make sure you're listening in, and we'll cue you into how we're feeling about the markets. Now, we're going to talk about what's happening this next week, but I just want to give you a brief recap of what's happening with what happened with those central banks. But moving forward, it might be a different story because this is a big week of data. Now, speaking of big weeks that are coming up, we have month end, or you can call it MEM. We have the month end Monday, and that's going to be where we see a lot of flows, and most banks are predicting that we're going to see some dollar selling coming into the market on Monday. So be aware that, we might see a little bit of a dollar pullback, going into Monday. And then once you get past the European close, perhaps we might see the dollar reassert itself. So just keep that in mind. We might have some dollar selling for end of month. And also one of the big things is we have earnings. We have big tech earnings next week. We two of them actually on Thursday. So Thursday after the U.S. close, make sure you're watching for Amazon. Okay, and here's the chart really quick, just so you can see a quick view of what's happening with Amazon. And this is a weekly chart, so just keep that in mind. Notice how we are up against the 50% retracement. Really struggling here. If we carve out a high around this week's or the end of the week top, this could end up being a head and shoulder pattern. If you can't see it, here's the shoulder, here's the head. It could be a shoulder. What I'm going to be watching is the 50 DMA on Amazon. If that breaks, that's a bad thing. If you break highs from 2 weeks ago, that's a good thing. So you got, upside pressure comes that way, downside pressure comes that way based on Amazon earnings. Now, remember, Amazon's a heartbeat on the U.S. and global consumer, right? So really important earnings to see how the consumer is dealing with these inflationary pressures that we all know are present. Even though it is more disinflationary right now, still prices are elevated. And how's that affecting the consumer right now? I think Amazon's going to be a very good read on that. Also, what else is happening this week is we have Apple. If you haven't looked at the Apple chart, well, we have an ascending wedge, divergent relative strength. I think that's a risk. I think that's a risk because this is a, when you have an ascending wedge like this is a reversal setup as it stands. Now, that doesn't mean we're going to get a downside move. We could very easily break out to the upside. And next thing you know is this ends up being more of a channel versus an ascending wedge. That's entirely possible. It's just the odds favor a reversal at this point with this type of setup. All right, so we have Apple. Now, I also want to talk to you about last week. We talked about Microsoft. Microsoft and Apple make up a big chunk of the U.S. tech sector. Keep in mind, the Microsoft had a false breakout, and it's still trading below 340. So, you start seeing some selling coming into Apple, Amazon, and then you got Microsoft. It's already it's already wounded, right? It could greatly influence how the U.S. indices trade. Now, we're going to go back to the U.S. indices here in just a few moments. But I just wanted to point out that we have those two tech giants that they have their earnings this week on Thursday after the close. Also, before I get into currencies right now, I have to say this. If you like these videos and you think they're beneficial, make sure you give us a thumbs up and make sure you subscribe to the channel if you haven't already. All right, let's go into what's happening this week and what we need to be watching. So on Monday, we have, it's actually going to be Sunday night. We're going to have the Chinese PMIs. Now, PMIs is going to be, you're going to see a lot of PMIs this week, but we're going to have China PMIs. So just keep that in mind as we go into this next week. We also have, out of Mexico, we have the Mexican PMIs. Look at the dollar mex. We closed at the lows of the week. So if you guys aren't aware, we actually have the next level for the dollar Mexican peso is this 1557, which we're really close to. And that is, if you haven't seen it already, I'll just show it to you right now. That is the 127% extension of the post-COVID move. Comes in, depending on, you have to be really, right to the tops and bottom. Comes in around 1657, but you can see it here about 1650 as I'm just eyeballing it versus going directly to the exact price. But just something I want you to keep in mind that there is some support just below the market with Mexican PMIs. Now, that will be on Monday. Oh, I'm sorry, that's Mexican GDP. I said PMIs. That two PMIs is on Tuesday. We have Mexican GDP come Monday. We also have out of Monday morning, we have the Eurozone CPI. I know I just talked about that. And, we talked about how important this euro is going to be right at this 109.50 level. That is really vitally very important to the bulls right now that holds. Because if you break below this low, it is going to be a little bit bearish. There's something else that's happening on Monday that if this is kind of a new piece of data. It's not new. I think it's actually a couple years old, if I'm not mistaken. But we have the SLOOS. Do you know what the SLOOS are? Not sleaze. SLOOS. It's the Senior Loan Officer Opinion Survey, and the reason why everybody's focused on this right now, the SLOOS, especially over the last couple months, is because, as you all know, and we hear about it in the auto industry, auto sector here in the U.S., but also in just loans in general. This is, loan officer sentiment survey. And as conditions continue to tighten, we want to know we or economists want to know, and everybody wants to know how lending conditions are, because if we continue to see them contract, that's going to affect the economy moving forward. Less money in the system. It's going to, offer further tightening in, the money supply, just generally speaking. So the SLOOS is something that happens on Monday. We'll be getting a read on that. It could actually impact the market. We also have an RBA decision, which will be Monday night, but it will be Tuesday morning if you're in Australia. This is a big deal. And let's go take a look at the Aussie really quick. The reason why this is such a big deal is because most, first of all, let's look at it technically. First of all, we have a double top. You guys see that, right? Double top developing. Here's your neckline right there. That means that this move is what would be expected on a breakdown. So on a breakdown, you could say ultimately that's going to take us down to 63 cents, just below 63 cents if it happens. I'm just eyeballing it here, obviously roughly telling you what that's going to look like. Why is that a big deal, and why should we be focused on it? Well, first of all, we're coming right down towards support. Let me just move this, and I'm going to just move it right here. We're coming right down to support, but the market is expecting, well, I think it's kind of 50-50. Some people are expecting a hike, but there are a silent minority that are expecting the RBA to stay unchanged. And if that happens, that's going to be relatively dovish for the Aussie, because expectations are for the RBA to raise rates. But if they don't, we could see the Aussie push right through the support. So watch this 65.90. I think it's 65.95. I think is the number that I've been writing down every day. Let's see, what number do we write down every day? We do this analysis for the Forex analytics community every week. If you're not around in the community. So 65.95, you can see I have an asterisk there. That means it's super important. If we come breaking through that, this next week, that's going to set up a double top. That's going to set up a very bearish move in the market. That's going to be, something that my opinion is we should be, focused on, further downside in the Aussie dollar. Now, remember, that is Tuesday morning or Monday night. If you're in the U.S., I'll be in front of my computer probably for that as well, inside the Forex analytics community. Let's talk about Tuesday. So Tuesday, we have ISM manufacturing data out of the U.S. Remember, this is a non-farm payroll week because it is the first week of the month. And the first Friday of the month, typically we'll have the jobs report. So we will be focused on what happens with ISM. We happen to get both the manufacturing and the services read this week. Plus we get JOLTS data, blah, blah, blah. We get a weekly unemployment claims. We got a lot of ADP. We got a lot of stuff out of the dollar out of the U.S. before the actual NFP on Friday. But one of the big ones are going to be ISM manufacturing. We are dipping now into, and we have been dipping into contractionary territory below 50. And even though we're expecting a little bit of an improvement this month, it's still below 50. So, watch that manufacturing data. We also have the JOLTS jobs report. That'll be on Tuesday. Again, Mexican PMIs. You saw the dollar MEX. And then later on, well, it's Wednesday morning, but Tuesday night for those of us in the U.S. or in North America, we will have New Zealand employment. So that's going to be Tuesday night, or obviously Wednesday morning in New Zealand. This is what I'll be looking at. Do you see what I'm drawing here? Right, lower trend line. Notice how we held. Now, obviously, if you're in the Forex analytics community, the charts you're going to get here are different than the ones I'm drawing for you because I update them throughout the course of the week. So you can see we have a bear flag pattern, and you can see we were targeting a move down towards that trend line support. So we do have a bear flag in play, and that trend line support is coming into play. Well, guess what? On Friday, we hit it. So if you guys didn't see this, this is a bear flag pattern. Right? It looks something like this. I'm just going to draw it out for you real quick. That means if it breaks down or that employment data is weak out of New Zealand, we could very easily head back to 60 cents. Now, 60 cents is a big round number, right? It's a big number. Everybody's going to be looking at 60 cents. There's going to be a lot of buying and selling right around that big figure number, but it's possible we could test that this week on a weak New Zealand employment. Speaking of employment, on Wednesday, we will be covering live on our face show. We have the ADP non-farm. And then later Wednesday night, we'll have the China Caxton PMIs. Thursday morning. Okay. We haven't looked at the Swissy in a while, but I'm gonna give you a view of the Swissy that maybe you haven't seen if you're not in the Forex analytics community. And this is, pretty important to me. So, and I don't have any Swissy exposure. I'm just, telling you that right now. All right. First of all, do you see this low right here? This is a weekly chart, just to be clear. Okay. So this is a weekly chart. You see this low? Boop, right? That's a big breakdown point. That comes up around 57.5 or 57.5, 87.5. You see it right there? Okay. Now going over to the daily chart, some of you might be like, well, Blake, that looks like just a bearish consolidation. It does. I would agree with you that this really looks more like a bearish consolidation. But before you get too crazy, what you may not see here, and let me just show you, is we're also at channel support. Do you see that? So why do I point this out? If inflation or disinflationary pressures continue to be a thing globally, because it is in the US, it is in China, it is in Europe, it is everywhere, right? And so if it is in Switzerland, if we see weak CPI Thursday morning, there's a good chance that we could see the US dollar Swiss franc push past 87.5 and back to the 50 DMA. So that's something I want you guys to be watching, especially for those of you that like to trade the Swiss franc. I do from time to time when the setup is right. And right now, setup is right. Also, the big event on Thursday is going to be the Bank of England. Now, this is a tricky one. And you guys remember last week we talked about this channel, and here's the support zone. You guys see it all. We drew it all out for you last week. Guess what? We hit the bottom of the support zone as expected, and we bounced. But, okay, so what have you done for me lately, Blake? That was last week. What's this week? Well, what's so important this week is we do have the Bank of England, and that happens on Thursday. So this tells you and should tell you right now that this low from last week, 127.60, is vitally important to the market. And if that breaks and that channel breaks right there, you should see some further selling. And you can see the 50 DMA is just below that. Now, if we break a dip from the 50 DMA to the 200 DMA is not out of the question. And as I pointed out to you last week, if you just watched the last week's week ahead video, I talked about a 400 pip drop or a 400 pip, distance between the 50 DMA and the 200 DMA. It's closed up a little bit. It's like a 350 pip drop, but that's still a big move in the grand scheme of things, especially if the Bank of England, goes 25 and maybe they're dovish. Now, there is speculation that the Bank of England could go 50. I think Andrew Bailey is a wild card. Really, I mean, if you're the Bank of England, you have a very difficult task right now. Do you continue to raise rates to fight inflation and really just crush the economy, just kill the economy in general in the UK, to avoid stagflation, or do you try to promote growth a little bit and hopefully these disinflationary pressures globally come into the UK as well, and you support the economy? If you're in that camp, then maybe the Bank of England is going to be more dovish. But I know a lot of you out there that are listening to me right now think that, Andrew Bailey from the Bank of England just doesn't have balls. Well, how about if he does? And how about if he's more aggressive and hikes rates by 50%, especially after the last CPI reading you got? If he wants to just put inflation to bed, even if it means leaving the UK economy for dead. I just rhymed. Wow, I rhymed. That was good. I didn't even mean to do that. But it's going to be tricky. So for those of you trading the sterling, I think the do or die level is right here at 127.50 roughly. You know, or you can say the 50 DMA. You know, maybe that's your bull bear line. You go above and below, above, below, above, below. But that's your real big pivot right there in the sterling as we go into the end of the week for the Bank of England on Thursday. Now we have ISM services data that's coming out. We have weekly unemployment claims. That's going to move the market. You know, those could move the market obviously as we prepare for the non-farm payroll this next week. And Friday we have not only the U.S. jobs report, we also have the Canadian jobs report. And I don't know if you guys caught it on Friday, but we closed at the highs on Friday. The market just continued to squeeze right up until the end of the day. You look at the 15-minute chart, we were just squeezing right into the close, right? So when you look at that, you know, you look at the dollar Canadian is really starting to base here. And if we get a move above, you know, the 132.50 level, I know we're basically at it, but if we get a close above that, you know, that could really, really impact the dollar CAD, because the Bank of Canada right now could really signal a pause, especially if this data is weak. So the next BOC meeting may end up being a pause, and that would just further fuel Canadian dollar weakness. Also, I don't know if you saw it, but crude oil is actually struggling around the $80 level. Now, here I haven't drawn a lot on crude recently on the week ahead video, but if you don't know why that's such a big deal right now, that's 161% extension of this move. Do you see it? Look at that. It's like magic. We stopped. Basically been stopping there. Now, if crude oil reverses and it goes lower, that's just going to fuel the fire for more Canadian dollar weakness, which you can see again, building that base off of a long-term channel support, something that everybody should be paying attention to. Also, you know, like I mentioned, the jobs report, you know, the U.S. jobs report, I do have to mention this if I haven't already. I don't think I have, but let's just go ahead and talk about it. Once again, the dollar index, critical resistance is at 102. We break above 102, 102.10, it's going to be squeeze city. Now, what could fuel the dollar higher on Friday? You know, obviously you got all this, you know, data heading up into the Friday jobs report. You got services, ISM, manufacturing ISM, JOLTS jobs reports, weekly unemployment claims. But if, you know, I don't care really what the data is so much. I mean, obviously if you get, you know, if we lost 200,000 jobs or we made 400,000 jobs, that's going to matter, because the market's looking for 200,000 jobs to be created, right? But what's really going to matter is going to be sorry, I'm just lost for words. It is the weekend, so you got to give me a little bit of a break. It's going to be the average hourly earnings. The market's expecting a little tick down in average hourly earnings, but how about if that doesn't come? Remember, a lot of people, myself included, feel that inflation is going to be sticky moving forward. I do feel that this is the last leg of a big, long marathon. And this is your last leg of the race, and it's not the easiest part. This is the hardest part. This is where shit gets real. And when you are thinking about inflation, getting inflation down from wherever it was to where it is now, that was the easy part. It's the last leg of this getting below 2% that's going to be very difficult in today's environment, especially with commodities rallying all over the map. So, if average hourly earnings, and remember, our jobs data in the U.S. has been very strong, much stronger than the market, myself included, has expected. And I don't know if this last month, you know, of July is going to be the month that signals a turn in the U.S. jobs report or U.S. jobs market. I think it might end up being more as we get into the fall. So if that is the case, we could have strong data. If I'm right here, we could have strong data and push the dollar well above this resistance going into next week. But that, again, I cannot reiterate enough, that 102 level will be very important. Okay, we are going to go into the indices, and I want to talk a little bit about the indices and where we're at there. But before I do that, I need to mention that if you guys have not checked out the trader funding program, make sure you do so. I've tweeted, if you follow me on Twitter, I'm at Pipzar. I actually just retweeted Nick, and he just passed $1 million assessment. He shared with you again how he's done it. And some of the things that you have to pay attention to, especially with the risk management piece, make sure you watch that. But what better way to take advantage of trading our money in a period when you have higher volatility? When you have high volatility, you have more of an opportunity. So if you don't have access to trading a $25,000 account, or you don't have $50,000 to trade, or $250,000 to trade, or heck, if you wanted to trade $1 million of our money, like Nick is right now in a live environment, where now we're profit sharing between Nick and ourselves. If you want to try to get there, check out the trader funding program, because not only would you be, taking an assessment to see if you can trade and qualify to trade our account, but you're also going to be involved in the Forex analytics community. And that's the difference, is being inside of our community, being able to talk to people like myself, myself, other analysts, get information you're not going to get anywhere else. Talk about the S&Ps. You can go into the trades room and see what trades we're taking. You can go into the news and research room and get news and research from all of our community that just posts things, what they've seen. Spanish chat room, a macro chat room called the Flowonomics room. Guys, this is where it's at. We're here to support you in your journey, in your trading journey. So if you want to trade our money, we do want to make sure you're in our community. So check out the trader funding program when you get a chance. Okay, now I'm going to go back to the indices really fast, and let's talk about just a few things that have caught my attention. Now, if you did not see it, the German DAX, let me find the German DAX. We hit all-time highs. Yeah. And we're like, hey, man, you break it back above 16.3, there's a good chance we're going to hit all-time highs. But look at that ascending wedge. Yes, we came out of the ascending wedge. Yes, we're about ready to test the underside of that ascending wedge. So if you're long the German DAX, just keep an eye on that. But we continue to break higher. That's a fact, right? Now, if you look at the Nikkei, let me get you over to the Nikkei really quick. We're still flagging. Divergent relative strength, and one of the things that supported the Nikkei and the reason why we came back up again to the flag highs, but we are at the flag highs, is, not everybody's convinced that the BOJ is going to normalize policy, not normalize rates, especially when their 2024 inflation forecasts are below 2%, right? So that's keeping the Nikkei supported. So right now, as we look at it, it is a bull flag pattern, and we're in breakout territory while we're above 31,000. I know I mention this to you all the time. And look at relative strength. Relative strength has now moderated. You know what that means? Have you ever been on a plane? I know those of you in the U.S., if you've been on in the plane, you see the unbuckle sign. It says you are now free to move around the cabin. Well, guess what? Once you're overbought and RSI gets back to neutral, which it is, that means we are now open to further upside if the Nikkei wants to move that direction, which is entirely possible. Okay. Also, we should look at the NASDAQ. The NASDAQ is stalling at the 161% extension, right? Now, this is important because here we are. There's a 161% extension because we have Amazon and Apple both reporting on Thursday. Also, we should take a look at the Dow. The Dow broke higher, but we're stuck at the 127% extension and consolidating gains. Did you hear what I said? Consolidating gains, not reversals. Consolidating gains. It's still in breakout territory. So that means it's still bullish, right? It's bullish until it's not. Right now, it's still bullish. All right, continuing on. One of the other things, this has me a little concerned. Now, I'm gonna say this really quick about the Russell 2000. We're at triangle resistance. This is kind of like the heartbeat of America. America, yeah, heartbeat. The heartbeat is the Russell 2000. It's our, like, the mid cap stocks, right? So we're stalling around triangle resistance. Just keep that in mind, just in case it starts to turn lower. That you'd start thinking, okay, well, maybe that's going to start to affect other markets as well. Last but not least, I do need to mention this really quick before I go. Gold. Stelios Contagula. Stelios, if you're listening in, hey, buddy. He's one of the partners at Forex Analytics, but he said something to me on the other day. He talked about me being bearish gold, like that's my sentiment. He can't remember the last time I was bullish, and I'm like, you're right. Actually, the last time I was bullish was when we were up here at the highs. But now that we made that like triple top up there, I'm not so bullish. So yeah, I could argue that he is correct. I've been bearish gold really for the last several months. Okay, but I don't know if you guys have seen this. We have an inverted head and shoulder pattern developing with gold. That means if we break above 1985, it's bullish. And I just said that. Stelios, if you're listening. Now, if we break back below the 50 DMA, that means we're probably going to get a continuation. And that should be watched as well if you're trading gold. So the numbers that still matter, the levels that still matter, especially if you're trading gold, is 1930 on the downside. That's support. Resistance is 1985 spot in the spot market. So a break above 1985, bullish. Inverted head and shoulder pattern should take us back up towards highs. Break back below 1930, it's bearish. We'll probably head back to the 200-day moving average. All right. With that being said, I just want to say, guys, gals, I know it's a weekend. I know your time is very important. So I want to thank you for spending your time with me and choosing to spend your time with me. So I hope you all have a great remainder of your weekend. Next week's going to be really busy. Make sure you catch us on not only the Face Show, where you're going to catch me every day for free, but make sure you catch us at the Flow Show, especially if you're up and trading during the European hours. All right, guys and gals, my name is Blake Morrow, and I will see you on Monday. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.